Hey everyone, this is Safe Trader Profits, and today I'm going to be talking about how I made $1,600 in profits from Domino's Pizza in just 2 days. I hope to teach you my strategy and hope it works for everyone watching. Everything I'm going to say is based on my opinion and entertainment. Please make sure that you speak to a certified financial advisor before making any decisions on stocks and options. So now let's dive into the video. So as you can see here, I purchased 40 DPZ $300 call contracts right here at a price of $420 each. The par value is $4.20, and remember each contract is 100 shares. So the par value for each share is $4.20. So it's $420 for each contract. The total price I paid was $16,800. So as you can see from the red lines from my tax returns, I purchased the 40 contracts on July 16th, 2019. So they're 6 months into the future. So I had a lot of time for this to fluctuate from up and down, but I decided to just take my money and run in just 2 days. So this is a cropped 1-year chart on Thinkorswim, and you will notice on July 15th, 2019, the price of Domino's was at $283. So just one day before I purchased it, it was at $283, and then it went down. And as you can see, the RSI, which is also known as the Relative Strength Index, went below 30, which usually signals a buy. So that light blue line went under 30. If we zoom into Thinkorswim here, you will see my dates are now a 1-hour chart from July 16th to July 18th, 2019. The yellow arrow represents where I purchased the 40 contracts on a chart of 2 days. And as you can see, I purchased it while it was going down. So as you can see, I purchased the 40 call contracts when Domino's was trading at $247.93. So I was expecting a $50 jump in the next 6 months. If you notice the yellow arrow on the bottom, that's the RSI being under 30 and the time I purchased them, which was at 1:14 p.m. So staying on the 2-day chart from July 16th to July 18th, 2019, you will see that Domino suddenly gained on Wednesday, July 17th, as represented by this yellow arrow right here. So throughout the whole day on Wednesday, it was gaining. This is because the earnings that came out on July 16th that crashed the stock were not as bad as originally thought. Domino's missed their revenue numbers but beat on earnings. I made a judgment that I've had enough gains and decided to sell the 40 contracts. So I made this decision on July 18th, 2019 at 2:27 p.m. as represented right here on that white arrow and this yellow arrow on the bottom. It was at 2:27 p.m. So right in between the red bar and this green bar right here. I sold them when the stock price was trading around $252.88. So the stock gained about $6 since I purchased the original contracts. Here's a screenshot of the option right before I sold it. So as you can see, my average cost was $4.20 per share. So for 40 contracts, that was $16,800. And the current price trading at this particular time was $4.55 for each share. So 40 contracts represents 4,000 shares. So the total return was $1,400. And it kept going up. So here's another screenshot after I sold it. Like I said, I sold it at 2:27 p.m. I sold it at $4.60 per share. So my total revenue from this was $18,400 in 2 days. And it wasn't set to expire till January 17th, 2020. You know, you can pick thousands and thousands of companies on the New York Stock Exchange. In the next slide, I'm going to talk about why I selected Domino's. So somebody might ask this question, why Domino's? Why did I pick Domino's to invest in? Well, the reason is because they're a well-known company. They're actually number one in sales of pizza among the big four, which are Pizza Hut, Domino's, Papa John's, and Little Caesars. So Domino's actually overtook Pizza Hut in February of 2018. And I think a lot of people can see why that happened. Pizza Hut's quality kind of went down. So the other thing about Domino's is they're actually high quality. If you go into a Domino's, I've heard from many people that they taste better than Papa John's and Pizza Hut, and that was recently. And what I mean by low prices, they're two topping medium pizzas for $5.99 each. It's actually a great deal, and actually a better deal than their competitors. So the other thing to look at when you're buying a stock is the PE ratio, but also the market cap. The market cap was only $9.4 billion when I bought them. This is much lower than many other companies in the same industry. There's a lot of companies that make money, but Domino's makes a lot of money and their PE ratio is really low. Starbucks, for example, is at $100 billion. Now let's dig into why that is actually the case. The main reason is because they're also very popular in New York City, on Wall Street. When you're on Wall Street or around Wall Street, a lot of people will just buy your company, honestly, buy your stock. So a company like, I'll give you an example, Kroger probably won't get the same attention as a company like Shake Shack or Starbucks, which is in New York City, right next to Wall Street, where everybody, all the traders are trading every single day. So we have to look for undervalued companies that are also well known. So that's why I bought Domino's. The other thing that I saw that was interesting was pizza is actually the number one food. And Domino's has actually bragged about that many times. So what I mean by big tech is you can order Domino's from your phone, whether it's an iPhone or an Android, just by downloading the app. You can also use the Alexa device. You can text a pizza emoji to Domino's, and you can get pizza delivered to your door. And if you navigate through the app and compare it with other apps like Papa John's or Little Caesars or Pizza Hut, you will notice the Domino's app is actually much easier to use and more eye-catching. They also have a 5-step tracker, so you know exactly when they started making your pizza and put it in the oven and when it is ready. They actually have a patent on this, so nobody else can do it. And I also saw in the news that Domino's teamed up with Ford on self-driving delivery cars. And you know they can do that because Ann Arbor is not that far from Dearborn, Michigan. And that's something that no other delivery company is doing other than Uber Eats. But it looks like they're in some financial trouble right now. All these tech investments are paying off and will continue to pay off. So this is a perfect example of a restaurant company and a tech company merged together. They don't need Grubhub. They don't need DoorDash. They don't need Uber Eats. They can do all this stuff by themselves. It's very rare to find companies that do this, all the stuff by themselves. This is something that other companies, including small businesses, say to Grubhub or DoorDash, I got to use you, especially in this health scare right now. But Domino's is doing it themselves. And it's a very rare occasion to find a company doing both those things. And all these investments, I think, have paid off and will continue to pay off. And this is what I mean by safe trader profits. I mean, you got to make sure that, you make like the best investments, and also got to focus on, actually making money. It's very important. And I see a lot of people making mistakes when it comes to calls and puts and things like that. And they buy certain companies wrong. And I just hope this gives you a better baseline of what to look for before you invest in a company, because there's so many fish in the water in terms of companies in the New York Stock Exchange. And I'll be honest with you, I hate to say this, but about 85% of them are garbage, total garbage. So you got to look through and find which ones are actually going to make money for you, make money for you. So if you guys like this video, make sure you like, comment, and subscribe. I'll be reading the comments. And if you want more videos like this, just let me know in the comments below. Thanks so much for watching. I really hope it helped.